Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Good day, everyone. Welcome to another Cambridge podcast. Hope all of you are doing well and are getting ready for the end of the year and enjoying the holidays. On behalf of the Cambridge family, we want to wish all of you a wonderful holiday season and a most prosperous new year. Over the last couple of weeks, we've been doing a number of podcasts and webcasts regarding one of the major capabilities that we have here at Cambridge, which is our life insurance appraisal and/or auditing program. You know, for many, many years, we have been auditing and appraising life insurance policies that our clients have owned for many, many years. So over the past 10 years or so, we have reviewed approximately 1,700 life insurance contracts. And what's interesting about this and why we're going to have this conference podcast today is that in over 70% of all the cases that we have reviewed and or audited, we were able to find that many and the majority of those contracts were actually failing and or lapsing without the clients being aware of it. So providing and promoting a strong life insurance audit program is very critical for all of us here at Cambridge, and it should be for you as a client. And now, sadly enough, you know, the majority of the times when we encounter new clients, because with our existing clients, we do those audits on a regular basis, so they really don't have to worry about that. But for many of our new clients and friends, you know, they have purchased life insurance contracts, you know, several years earlier, and they have not done any type of due diligence on those contracts. They put them in a drawer, they pay their premiums, and they think that everything is good to go. But there are so many different variables inside contracts that is very critical to understand. So I felt that today having a podcast on what would you do if you understood the power of life insurance would be a very critical one for all of you here on this podcast. And I think that's important to know, because if you have an understanding of the features and benefits of life insurance, if you have an understanding of the impact of those features and benefits and how they impact the IRS code, and if you also understand the versatility and the usage of different types of insurance contracts, I think you're going to be in a much better position than you could have been otherwise without having the information. Now, always remember that information without education always leads to failure. So here at Cambridge, our number one goal is to make certain that we provide you with the right type of information that is going to give you the education necessary for you to be successful in your financial life. Now, talking a little bit about the features and benefits of life insurance, and I say this from the bottom of my heart, if there's one product that everyone should own, it's a permanent life insurance contract. I would even argue that if all of a sudden the U.S. government tells us that there's only one product that we can purchase for our financial wherewithal and our financial benefit, what would that product be? Without any doubt, for me, would be life insurance. And the reason for that is the many benefits and the many types of usage that you can do with this type of contract that you cannot do with any other type of investment product in the United States. So what are some of the key features and benefits in understanding life insurance? And if you understood it the way I understand these contracts, you know, what will you be able to do with it? So let's start by saying that, you know, life insurance is not a creature of the IRS code. You know, life insurance contracts have been around for hundreds of years, and the IRS code has only been around since 1913, so it's just north of 100 years right now. So the benefits that you see inside of a life insurance contract were not created by the IRS. So therefore, it is the product that enjoys the most taxable benefits compared to any other product that can be purchased or acquired under the IRS code. Now, another key feature is the tax-deferred growth of accumulated assets. So therefore, when you put money into a permanent life insurance contract, not only are you paying a premium that is going to take a percentage of that premium to cover the cost of insurance, the ultimate death benefit, which is the shell that provides the security that all of us need in order to protect our businesses, our families, our lives, our debt, and so forth. You know, one of the things that we talk about all the time is that for many of my clients, they purchase life insurance for two reasons. They either love someone or they owe someone. So if you love someone, you want to make certain that if you're no longer around, that they're fully protected, and that would include your immediate family. But also when you owe someone, you want to make certain that that liability is not imposed on your family members when you're no longer with us. So people usually buy it when they love someone or they owe someone. Now, when they do more sophisticated planning, we expand that to include, you know, the famous radio station that everyone listens to, which is WIFM, you know, what's in it for me. So they're able to generate a tremendous amount of benefits out of these contracts without having to die in order to receive said benefits. Now, one of the great features of life insurance is there's no 59.5 IRS rule for premature distribution. So you can have a lot of money in these contracts, especially if you fund it properly. And although the money is growing on a tax-preferred basis, you can actually access your money prior to age 59.5 without having to pay any penalties to the IRS. And that's a really great feature, because if you look at, you know, many of the other tax-deferred vehicles that are available under the code, like IRAs, 403Bs, 401Ks, and so forth, unless there are exigent circumstances, anytime that you invade money and take money out of those contracts prior to age 59.5, you are not only going to have to pay taxes, but you're also going to have to pay a 10% penalty on the amount of distribution. By the same token, since it doesn't have any 59.5 rule, it also does not have the 70.5 IRS rules for required minimum distributions. You know that if you own any type of qualified plan, whether it is an IRA or a 401K or a 403B, by the same token you have the 10% rule on premature distributions, you also have a required minimum distribution rule, which basically says that if you don't take money out of the contract starting at age 70.5, any amount of distribution that you should have taken that you didn't take, you will be forced to not only pay taxes on that distribution, but then you will be assessed a 50% penalty that must be paid to the IRS. Now, another key feature is that you have access to cash values at any time on a tax-preferred basis. And if you do it that way, you can put money after tax, the money grows tax-deferred, and then you can pull it out on a tax-preferred, tax-free basis if you do it the correct way. So it's a tremendous feature, especially now that we're talking about tax reform in the United States. You know, obviously it's about to pass, but nobody knows what it's going to look like. But ultimately, as far as we're concerned, the best tax bracket in retirement is a 0% tax bracket. Now, I live in the state of Florida, so in the state of Florida, life insurance is 100% creditor protected, and it is also creditor protected in many states. Now, depending on the state that you live in, make sure you look at the laws there and to find out how much of your life insurance cash value is creditor protected from a business standpoint. Now, the death benefit, once someone dies, is federal income tax free. So that means that if you have $1 million contract and you pass away, your beneficiaries under the contract will receive the $1 million on a tax-free basis, on a federal income tax-free basis. Another great feature along those lines, especially upon death, is that it doesn't have to go through probate. The named beneficiaries, all they have to do is file a death claim, and they will collect their benefits if everything is fine with the contract. So it is a critical benefit, because if you do use it the proper way, not only can you as an insured or the owner of the policy can benefit tremendously from the features of benefits of the contract while you're alive, but then your family will also benefit upon your death. Now, these contracts, especially the new ones, have certain riders and benefits that were not available before. And this is where doing life insurance audits is so critical. So we spend a lot of time doing these audits on behalf of our clients and friends. And just so you'll know, we do these benefits at no cost or obligation to our clients. So this is just part of giving up to the financial community, and that's something that we do. If the clients do decide to use our company to do these services later on, then obviously, we'll get paid at that time by the insurance carrier where we may place the business. But the client is not obligated to do business with us, and we look forward to doing these audits at no cost or obligation. Now, some of the major riders, I'm not going to name them all because there are many of them, but the big ones are critical illness, long-term care riders that were not available a few years ago, and disability waiver of premium riders, just to name a few, or some of the critical features. Because one of the major problems that we have right now, and just for your information, the cost of life insurance per thousand has been decreasing steadily, over the last 20 years. And the reason is simple. People are living a lot longer today than they ever did before. But then again, it doesn't mean they're going to be any healthier. As a matter of fact, there's a very high probability, as I've stated in other podcasts, that if you live a long life, there's going to be a very high probability that you and or someone in your family is going to have a need for long-term care. So obviously, the big issue is you can purchase a long-term care contract and you can pay premium. So if you're 50 years old and then you happen to die in your sleep at the age of 85, and you never needed long-term care benefits, and not only did you lose that premium that you paid, which is like paying for car insurance, but then also you lost the opportunity cost of what you could have done with that premium. Had you known that you were going to die in your sleep, you could have invested that money somewhere else. Well, by adding these long-term care riders to existing life insurance contracts, someone is always going to get the benefit. So if you have $1 million coverage and you have to go into a nursing facility for a couple of years, and out of the $1 million, you have to use $300,000 of that coverage to pay for your expenses, then upon your death, the remaining $700,000 will then be paid to your beneficiaries according to the features of the contract. Now, another major benefit that you have, and this is why it's so critical to understand, the features and benefits of life insurance, is that it allows for a much higher contribution limit than in qualified plans. Pretty much the limits on the contribution that you can make to a life insurance contract is based on the amount of death benefit that you purchase and your age. So, for instance, you may purchase a contract that may say that your minimum premium is $5,000 a year and the maximum is $25,000. So between $5,000 and $25,000, you can do whatever you want to do. You can fund the contract this year with $5,000. Let's say that next year you really have a nice pay raise or your business did very well, and if you want to shelter money away, and then next year not only can you put the $25,000 for next year, but you can also catch up for the previous year. So since you only contributed $5,000 in the first year, and you could have contributed $25,000. Now you can take that extra $15,000 plus the additional $25,000, so you can contribute $40,000 in the second year as well. And if you just did the basic contribution for year 1, 2, and 3, but had a really nice pay raise in year 4, you can max out the contract in year 4 by putting in the $25,000, and then the difference in what you didn't contribute to year 1, 2, and 3. So it gives you that tremendous catch-up flexibility that is not available under any other type of contract. So many of my clients use these contracts as supplemental retirement plans. Max fund the contracts, because the more money that you put into the contract, the better it's going to do for you and your family. Now, what are some of the impact of features and benefits of the IRS code when it comes to these contracts? Number one, it is critical to understand that we at Cambridge, we specialize in creating tax-free retirement plan. And at the end of the day, our number one goal when we work with our clients is to make certain that they can divorce the IRS in retirement for as much as they possibly can. Now, life insurance is one of only 4 tax-free vehicles in the IRS code. And those are municipal bonds, Roth IRAs, Roth 401ks, and life insurance contracts. Other than that, there's no other vehicle in the IRS code that provides tax-free income. Now, out of the 4, there's only 3 tax-preferred vehicles in the IRS code for provisional income calculations. And life insurance happens to be one of them. So out of the 4 that I mentioned, municipal bond funds, Roth IRAs, Roth 401ks, and life insurance, only life insurance, Roth IRAs, and Roth 401ks do not provide a negative impact on provisional income calculations. And basically provisional income calculations, and we've done other podcasts along those lines, but provisional income calculations determine what percentage of your Social Security benefits are taxed in retirement. So if all your retirement income came from Roth IRAs, Roth 401ks, and life insurance, it could be, $100,000, $200,000, $300,000 of income. None of that income would have a negative impact on your Social Security benefits, and therefore you and your family would receive those Social Security benefits on a tax-free basis as well. One of the major problems and one of the major things that we do at Cambridge is that we do fast-forward planning when it comes to Social Security distribution to make certain that our clients are able to receive their Social Security benefit on a tax-preferred and tax-free basis. Now, life insurance has a tremendous amount of versatility and usage. And many of my clients, whenever we sit down for the first time to discuss insurance planning, many of them that own life insurance, number one, have no idea what type of insurance they own. Number 2, they have no clue as to how their contracts work. And number 3, they have no understanding of the features and benefits, because many of them have said to me after we do our due diligence and we do the audits, they basically say to me, Bert, had I known this 5, 10, 15, 20 years ago, I would have put a tremendous amount of money into these contracts, and I wish somebody would have had the opportunity to explain it to me the way you do. But what are some of the versatility and usage of these contracts? Number 1, these contracts can be used as asset replacement for annuitization and or spend down. Think of it this way. If you have $1 million in assets in retirement, I'm just using $1 million as a number. It could be, $500,000, it could be $10 million, it doesn't matter. Most Americans don't have enough money in savings to just live off the interest. So many of them are not going to have any other choice but to invade principal and start taking principal and interest at the same time. Well, if you're married filing jointly and you love your significant other, everything is good. You can start taking principal and interest, but upon your death, there may not be any principal left to continue to provide an income benefit to the surviving spouse. So life insurance brings all of that to the forefront. If you have $1 million of life insurance benefit that is guaranteed, and you also have $1 million of assets, you have pretty much earned the right to start spending down or annuitizing by going to an insurance company and purchasing a guaranteed annuity for the rest of your life, whereby upon your death, although those assets may have already been spent down, the $1 million death benefit proceed, which is received by the surviving spouse on a tax-free basis, now would replace all of that income that was used while the two of you were alive during retirement years. So it's a great tool to be used as asset replacement. The second area that you can use this product, and by the way, there are 30 different usage of these contracts, but I'm just going to touch upon a few of them, is the area of supplemental retirement planning. Remember, the money that you put into these contracts grow on a tax-preferred basis, and then you can pull it out tax-free. What a great vehicle to have when you can start taking distribution. And because of the fact that you are not obligated to take money out of these contracts at age 70 and a half, you can allow the money inside of your life insurance contract or your Roth IRA contract to continue to grow on a tax-preferred basis past the age of 70 and a half. So you can start setting up layers of distribution. So perhaps if you retire at 65, you start to invade your IRAs and your 401ks. And then once you get through that, then you start invading your Roth IRAs and or your life insurance contract to keep you going until the day that you die. Remember, the key benefit is you don't want to run out of money before you run out of life, because otherwise you and your family will be in major trouble. Now, another great feature and versatility usage for this contract is what we call here at Cambridge Social Security replacement. Now, all of you understand that, when a husband and wife are retired and they start taking Social Security benefits, whether it's age 62, 65, or age 70, usually there's someone, one of the family members has earned a higher income than the other. So obviously when they both retire and they're both alive, they're both taking their individual Social Security benefit. But when the first spouse dies, then the surviving spouse now has a choice. He or she has the ability to keep their own Social Security benefit or take their spouse's Social Security benefit if that benefit was higher than theirs. So many times there's that false sense of security where how spouses come in and say, well, Bert, we're not really too worried, because if I were to die, then since I make the most amount of money and then my Social Security benefit is the highest, then my wife will just take that benefit, which is higher than the one that she currently has. Yes, that's all well and good, but when she does take that benefit, she loses hers. So by doing Social Security replacement and using life insurance, not only will your surviving spouse be able to take the higher benefit, but most important, he or she will be able, through the death benefit proceed, to replace that benefit that was lost at the time of the first death. And many of my clients, when they come to see me for the first time, they have never done any Social Security replacement planning and or had been advised of how to maximize the opportunity and provide that security for themselves and their family. Now, these contracts are quite versatile. You can have choices of guaranteed growth. You can have stock market growth and volatility as well, or you could have a combination of both through investing in indexes and so forth. So it is critical to understand that there are many features and benefits, and when someone asks me, Bert, what's the best life insurance that I can buy? My answer is always the same: the one that happens to be in place the day someone dies. And again, because of the type of auditing that we do and the type of understanding of these contracts that we have the ability to find and put together and straddle the best features and benefits of these contracts to create the type of planning that you and your family are looking for. Now, the other great thing that life insurance does is that it provides protection against the 4 major risks that are affecting Americans today. The risk of dying too soon, the risk of living too long, The risk of living with a disability, especially with those long-term care features and critical illness features and disability premium waiver features that I discussed earlier. And also, most important, the risk of living with eroding factors. And what do I mean by that? Eroding factors are factors that you may or may not have any control over that have a negative impact on your assets, like taxes, inflation, market volatility, interest rate volatility, lawsuits, and so forth. So by having a proper designed life insurance contract, you can pretty much protect against the four major risks of dying too soon, living too long, living with a disability, and living with eroding factors. So again, these are just a few of the usages that you can have. Again, there are 30 of them, but I just wanted to touch upon a few. Now, as far as I'm concerned, and understanding planning the way I do, especially having been in this business for over 28 years, life insurance is the foundation of all financial and retirement planning. If you have life insurance at the core of your planning, everything that you do around it, it's going to be a win-win for yourself and your family. Think of life insurance as the sun, and all the other different products and services that you may have in your portfolio would be the planets running around the sun and riding around the sun. Now, as I said, life insurance should be the foundation of all planning because of its versatility and all the features and benefits that no other product enjoys under the IRS code. Life insurance, by the way, has the highest rate of return of all investment products from an economic standpoint. And that's when you really look deep into the features and benefits of life insurance, because life insurance possesses three different types of rates of returns. You have the internal rate of return. So that's the internal rate of return that the product generates based on cash, the contribution, the growth, over years, and what the internal rate of return on that growth is. It also has an external rate of return. As I said earlier on my example of, having $1 million of life insurance and then having $1 million of assets, and using that $1 million of assets as a way to increase the distribution rate on a guaranteed basis by invading principal and interest. Because remember, in retirement, it's not about the accumulation rate, it's about the distribution rate. So the external rate of return of life insurance is second to none, because by having life insurance, it gives each and every one of the investors out in the marketplace the ability to use their assets in ways that they could not use before. And by doing so, they have the ability to increase the distribution rate to a level that they would have never been able to obtain had not they had life insurance as the foundation of their planning. And then not only do you have the internal and external rate of return, now you have the eternal rate of return, which is that death benefit proceeds that is paid to the surviving spouse and or surviving beneficiaries. So when you really factor in the internal rate of return of what the product does internally, not only on the cash side of the equation, but also on the death benefit impact on a tax-free basis, and the fact that the money will be readily available immediately, that creates a major benefit to all of you. And then when you add the external rate of return, because now you have earned the right by having these products in place to be able to do things with your assets that you could have never done before, like purchasing and buying immediate annuities and or using pay down strategies. Those are things that when you look at any other product and service sold in the United States, nothing can come close to that. Now, another key feature and why it is the foundation of all financial and retirement planning that we look at is that other than defined benefit programs or pensions, it is the only product in the U.S. economy that provides a known amount of benefit at a known time. Most of the investments that you have, you invest and you put money away, and you think you're going to use it for retirement, like a 401k or an IRA, at age 65 when you decide to pull the trigger at retirement. And you're hoping, that you do good enough planning to have enough assets that when you get to your retirement age, you may be close to whatever your calculations were. But I tell all my clients that hope is not a financial strategy. But no one really knows. Now, if you happen to have a pension, that if you work for a company, for 25, 30 years at time of retirement, you're going to receive X amount of dollars, and that today. So you just have to make certain that you can get there. With life insurance, it's the same thing. You know exactly the amount that your family will receive upon your death. You just don't know when you're going to die. So when you combine the power of life insurance and you put life insurance as the center of your financial universe, you will find how everything else in your portfolio is going to work much better than it would have had you not had this product in front of you. So again, we spend a lot of time with our clients in educating them on life insurance and the benefits and the features, because many of our clients have done fairly well and they have a clear understanding of how their 401k and IRA works for the most part, or their investments and their stock mutual funds, even in their business. But when it comes to understanding the features and benefits of life insurance, the majority of my clients are not well versed in that area. So again, we always say, and I always say to all of you, that our number one job is to get you to change the way that you see things, because when you do change the way that you see things, the things that you see change. Thank you all so very much. Thanks again for being part of the Cambridge family and listening to our podcast on a weekly basis. We will continue to provide these types of podcasts to you in the coming years, and we want to wish you all a tremendous rest of your day.